Hello and welcome to Media Dialogues with Storyboard 18. I am Delshad Irani and today I'm in conversation with Dhiraj Relli, who is the MD and CEO of HDFC Securities. Dhiraj is here with us today to talk about HDFC Securities' 24-year-long journey and the highlights in both the firm's and the Indian market's evolution. Of course, fueling all this growth are empowered consumers, fundamental shifts in India's attitude towards investments, and rapid changes in the financial services industry. And of course, the move towards equitization of savings. Dhiraj is here to share insights into a fast evolving market and HDFC Securities' journey and future growth. So on that note, hello and welcome to the studio. Dhiraj, it's lovely to have you here.
I'm thrilled to be here and talking about my favorite topic, Indian financial markets, and that also HDFC Securities.
Absolutely, and what a journey it's been. It's been 24 years since HDFC Securities was set up. Dial back a little bit over those years, Dhiraj, and tell me what have been perhaps some of the key highlights of that journey, keeping in mind, of course, also the evolution of the financial industries, the investment space. How has that journey been for HDFC Securities?
So before HDFC Securities, I think the markets have transformed miraculously in the last 25 odd years. I will give you some data points to substantiate my point. I think the GDP has grown 8x from $470 billion to almost $3.8, $3.9 trillion. So 8x growth in last 25 years. If you look at the demat accounts, we used to have just about 20 lakh demat accounts in 2000 when we started HDFC Securities. Now 16.2 crore demat accounts. It 81x growth in the demat accounts.
Phenomenal.
Similarly, if you look at the mutual fund AUM from 1 lakh crore to 65 lakh crore, 65x growth. All this has happened on the bedrock of significant evolution in the form of digitization, adoption of technology, assimilation of technology at the bottom of the pyramid, and all participants in the markets. I think the regulators have played a pivotal role here. They kept on evolving the whole financial ecosystem. All regulators, not just about the SEBI in capital markets, it's Reserve Bank of India, PFRDA, or you look at IRDA. I think regulators have played a critical role in ensuring that we have a very robust, secure, and scalable ecosystem. In HDFC Securities, we kind of disrupted in early 2000 by starting to open 3-in-1 account. Earlier, it was more of a physical account, and most of the share were also held in the form of physical certificates and not in the demat certificates. Over the years, people started to dematerialize the same, and 3-in account helped us to link the saving account, trading account, and the demat account, and gave them an environment and ecosystem that was secure for them to transact in the capital markets. What has changed in last 25 years? I think now everything is happening digitally. We were opening account with 40 odd signatures. It used to be a full booklet of account opening. Yeah, from there to now, 5 to 7 minute journey to just sign up. I think this is remarkable, and also because of the Jan Dhan, Aadhaar, and mobility. So that has helped us to make India as a very large market. India was confined to only Maharashtra, Gujarat, and few large cities. And now India has become a very big market because we have seen the depth as well as the breadth increasing in the market ecosystem.
Let me stay on that for a bit, Dhiraj, especially your point about how sort of this tech-powered transformation has really changed everything, and given that depth and scale, of course, allowing players like HDFC Securities to really scale up. Dig a little bit into how the company, how the firm has mirrored that digital growth.
So like I just mentioned, that we changed the whole construct of the transaction ecosystem in the capital markets with 3-in-1 account. Then we've seen that there is an evolution and people have started to adopt mobility more. more and more people started to use mobile for not just conversation, but also for the transaction purposes, particularly in the banking ecosystem. So early 2008, 2009, we launched our mobile application, which was a basic application, but again, it would help us to migrate customers who were looking forward to access capital markets through the direct technology. So that has helped us. Over the years, I think we've seen that the markets have been disrupted. I think I'll give full credit to the many tech-led discount brokerage houses who have started operations in late 20s, and they basically disrupted the market on pricing as well as by introducing the state-of-art technology, which was scalable, user-friendly, and that's where we had to respond, and we then changed our mobile application, our web trading platforms, and very recently, last year, we've launched HDFC Sky, which is our discount broking platform. So I would say that we have now evolved as a more of a universal investment solution provider rather than, pure play broking entity. Other than the technology, I think one area where we have de-risk ourselves, that we are not dependent only on a broking revenue. We have evolved in the distribution of mutual funds, fixed assets, and many other products also, PMS, AIF, also providing advisory services to our customers. And now with the discount broking and also with partnership with many fintech, we could able to give solution on basket investing. Even customers who are looking forward to participate in global asset classes, we could help them to do investment in the global investment products also. So this is how we have evolved in last 20-25 years.
So Dhiraj, what is your vision for India in terms of investment growth, say for the next 10 years?
I think India will contribute 20% of the incremental GDP for the world in next decade or so, which means India will remain a darling for all investors. In fact, every single boardroom across the world have been discussing India as an opportunity. And it is integral part of their strategy when they are looking forward for growth. So
they're calling it India's decade.
Yeah. So we have demographics that are in favor of us, and I think also the whole ecosystem with the multiple decadal trends in India is also quite comfortable. I'll tell you, we are witnessing digitization, unparalleled digitization. No one in the world has seen this kind of a assimilation of technology, that too at a grassroots level. We are seeing financialization of savings. We are seeing disproportionately higher investment on infrastructure. We are seeing the more and more foreign portfolio investors participating in the investments in India. Of late, they have been not actively participating, but just to give you some data point, currently also they own 87 lakh crore in Indian equities, and total market capitalization for Nifty is about 460 lakh crore. So they still own sizable equity in India other than the promoters and domestic institutions. Domestic institutions, if you add mutual fund at 65 lakh crore and LIC another 35 odd lakh crore, so they'll be at par with the domestic institution or shade lower than that. So that way, I think this ecosystem is very, very conducive. And my take is that India will remain darling for all the investors in next decade and more.
Well put. But while we're talking about investors, let's talk about the Indian investor. Tell me, Dhiraj, how has the Indian investor changed? What are some of the fundamental shifts in their attitudes towards investing?
One big change, a dramatic change, is increase in the risk appetite of the investors. I think particularly millennials, Gen Z, and even now people who are senior citizens also, their risk appetite has changed. In last 25 years, they have seen the markets navigating many headwinds. We've seen the financial crisis in 2008 and 9. We've seen mother of all crises, COVID, and so much volatility. So my take is that risk appetite has increased. Also, they've learned to navigate the volatility. Volatility and timing in the markets are two bigger worries for most of the investors. And that's where I think the SIPs have played a critical role in India, and we are at about 20,000 crore per month SIP. I wrote an article about equitization of savings, where if we compound at the current rate only, we'll be in 2030 at 1 lakh crore per month SIP. So that's the kind of participation we are seeing, and that too, as of now, we have only 7% penetration of equity as an asset class, and long way to go to penetrate the same. I think what has played a key role is adoption of mobility.
Yes.
I think the people were not comfortable earlier to do their transactions on mobile phones. So they started to do few transactions, banking transactions, checking up their balances and transferring funds from one account to another account, and also booking their fixed deposits or so in the 2010, 2015.
Right.
So we, the whole financial system was migrating transactions from physical brick and mortar ecosystem to a digital ecosystem. But after that, I think particularly post-COVID, we have seen that they are getting more and more acquainted, comfortable with the whole ecosystem. And also it got to do with the SEBI's intervention, whereby the intermediaries like us as a brokerage house, HDFC Securities, have very limited access to the clients' demat accounts and also their holdings and their balances. So that way the secured ecosystem, the confidence and trust on the whole capital market ecosystem. If I will buy, my shares will come next day in my demat account. If I sell, 100% my money will come in the next day in the morning in my account. And now progressing to T+0 settlement, real-time settlements, I think we are at a bright spot.
But that the key word I think there is confidence, and to your point about the increase in the risk appetite. But let me just go back to your point on the equitization of savings, Dhiraj. I thought that was very interesting, and you've of course explored this as an article as well previously. But elaborate on that a little bit for us. What is the what is the idea of equitization of savings for you, but also the impact that we will see of that?
See, equitization is a very broad term. We were earlier, most of the investors were comfortable with the real assets. Real estate was first preference. Whenever you have a more surplus, you look forward to invest in a real estate in early 2000, late 90s. Then also through and through, we've seen that Indians have fancy for gold, silver, so physical assets. We've seen some migration from physical assets to financial assets in the last 2 decades. But in last 5-7 years, from financialization savings to equitization of the savings, which means getting more comfortable with equity as an asset class and navigating the volatility and understanding that if they invest in a systematic, disciplined manner, they will gain, they'll be able to beat the inflation. So that's where I think, equity as an asset class has played a major role. I think the education, investor awareness by media houses like you, players like HDFC Securities, regulators, and the IFAs, the whole ecosystem has played its critical role in getting this market, getting investors to get more and more comfortable with equity as an asset class. I think when I used to interact with the investors in early 2000, when market Nifty used to be at 3,000 to 5,000 kind of levels, people used to worry about the more and more volatility in the market. But you see, we've seen UPA, we've seen NDA's terms and so on. We've seen all possible vagaries of the markets. Now investors are comfortable that this is one asset class. If we do the right research, if we follow the right advice and hold it for a 3 to 5 years time, we can make decent growth.
We've seen this sort of heightened awareness, entire sort of class of investors has grown. With that, of course, comes many challenges, and you've stressed on the importance of doing your research. Education. Let's talk about investor education. What is the firm doing in that space? And also let's talk about what regulators have done right. And then, of course, I'll also ask you a question on influencer marketing, but we'll take that later.
I think, again, access to information has increased dramatically. There was an information arbitrage with the institutional investors versus the retail investors. Institutional investor earlier had an access to information. They could able to deep dive into the same. Whereas now with the advent of social media platforms, YouTubes, videos, media houses like you, we also create content and many intermediaries are creating a lot of content which is quite credible content, and it is available on the go to the customers. People are browsing through the small reels on the investments, and they are looking at long format videos, attending to our webinars. What we are doing, we are leveraging the technology. We are doing webinars regularly on specific topics. We create content and that's available on various social media platforms. And also we go and travel along with the depositories, exchanges to do a workshops or seminars at the ground also in smaller cities to connect with the customers, to assuage their concern, to clear their doubts, and give them more perspective about the opportunities and information about the markets and new products. By the way, the complexity over the years are increasing and will increase. Now we have REITs, InvITs, AIFs, PMS, and many more new products are coming up, and particularly passive funds will be in the foray for a big time in next 10 or 20 years time. So my take is that it's important that we put a credible ecosystem to disseminate the right set of information to our target investors or customers.
So, Dhiraj, it's interesting what has happened in the industry with the rise of, say, finfluencers, right? Of course, massive opportunity there, equally major challenges. We've seen the downside of it, we've seen the upside of it. What concerns you about this surge in content, in the appetite for content, in interest on both sides, demand and supply? So tell me a little bit about this ecosystem that we have right now. What concerns you? As someone who's, of course, been in the space a very long time, what troubles you?
I think there was definite demand for the content because retail investors, HNIs were looking for more information. So that's where, it gave an emergence of the influencers and many more people with the vintage experience, expertise talking about various subjects. But like any other activity, it is possible that many people who are not qualified enough to can also get into these spaces if it remains unregulated. So that's where I think the regulation piece of it and difficulty in regulating this particular piece is what concerns me, because anyone without any particular background, understanding, expertise can go and just merely talk about any stock, script or product.
Start the YouTube channel and the next thing you know, there are thousands and millions of views.
So I think there is a lot of noise. Investors should understand to filter these noise and look for a credible sources for the information. Like, there are SEBI registered investment advisors and research analysts. I think they should listen and they should follow them only. It is a matter of time only. You will see that this will settle down. So I'm not unnecessarily perturbed about it. I think some checks and balances will be able to deal with it.
But specifically at HDFC Securities, Dhiraj, what are you doing in terms of maybe some of your initiatives where you're harnessing all this potential of social media and, of course, the advance of digital media now with an additional layer of Gen AI? Content, for example, has been democratized. So tell me a little bit about what you are thinking from an HDFC Securities point of view.
So we are very clear that we are here to leverage our expertise, domain expertise of last 2.5 decades, and in a very simple, lucid manner, serve it to the customers and target customers. And this will happen in the form of simple content creation, short videos, long videos, webinars, meetings with them, and also because we are now connecting with the younger generation, so in the form of reels, whichever way, I think it's just translating the expertise to a simple information which is snackable information, which is useful and action oriented also.
On how we keep saying that Gen Z is, so hard to understand, we don't know what they want, etc. From a financial services industry point of view, how much of these ideas and conceptions that we have about Gen Z are real? Are they behaving very differently from, say, millennials, younger millennials?
I think the behavior was same even 3 decades ago also. I remember when I was doing my BCom honors in chartered accountancy, we were also discussing stocks even at that time also. Probably I was part of a minority, but now we've seen more and more interest coming in from the younger generation across all schools, colleges. People are discussing the equity as an asset class, various investment options. So plethora of information, access to the information is one reason, and also the chatter among themselves. They are discussing. We discount the Gen Z big time. We feel that they are casual. My take is that they are not casual. They may not, operate in a formal ecosystem, but they want to know more. They have their own inquisitiveness to know more about the markets. They do their own research also. Sometimes they get carried away also, which is part and parcel of learning evolution for anybody. It was there for everybody. So they are not different from the earlier generations, just that the risk appetite has increased a little bit more, and also aspirations are higher. So that's that's another big differentiator. Today we are in India where we are at a median age of 27, 28. Aspirations are very different than aspirations were 20 years ago.
But if you were to give a young person today some advice, someone who wants to enter the financial services industry, what advice would you give them today?
I think embrace the continuous learning, invest in yourself. There's enough and more information available. So find out the credible sources to learn. Pursue relevant certifications and short-term courses wherever required. Seek mentorship. Create small portfolio. Today you can buy even one stock also. In 500 rupees you can start investing in mutual funds also. So create your own portfolio. When you invest at your level, you will see the ups and downs in the market. You will see the volatility. You will witness corporate actions happening on your stocks. So that way you will be able to learn a lot more. I think other than that is that they need to have a right ecosystem of professional network also. So seek to be part of those networks where they can get better information.
Always good to hear that. Well, thank you so much for your time, Dhiraj. It was lovely chatting with you. Thank you.
Pleasure was all mine. Thank you for having me.